Hey everyone! I'm just one person, hidden deep in the countryside, surrounded by silence, but I built BlockSonic to speak with the entire world. Here, you don't get noise, you get the pulse of Bitcoin every single day, distilled into pure essential updates. No teams, no sponsors, no filters. Just me. A signal from the quietest place on Earth, bringing you the most important Bitcoin news before the world wakes up. With BlockSonic, you don't need to search for information. I research, I write, and I tell the story behind every headline. I do the digging. I chase the truth. All you have to do is listen. Today, our news: Bitcoin rebounds. But who becomes the seller now? Is really a question about human action under pressure. Who must sell, and who finally can buy? You've watched Bitcoin snap back above 65,000 after flirting with 60. Now we ask what changed. Was it conviction returning, or leverage being forcibly cleared so prices can speak again? We'll walk through the macro shadows still hanging over this rebound. Energy prices stirred by renewed Iran warnings, funding deadlines that can revive uncertainty, and why put demand tells you fear hasn't left. It's just been repriced. We'll also look at the quiet signals: ETFs barely moving while spot swings, miners shifting coins when cash flow tightens, and Bitcoin-linked shares trying to find footing as earnings disappoint. And we'll end with a longer horizon. Strategies, security planning under quantum uncertainty, because even tomorrow's risks become today's incentives. Recovering Bitcoin still walks through macro shadows. Your day ahead, February 6, 2026, seen through the logic of action, fear, and fragile confidence. You are watching a familiar paradox unfold. Prices can turn green in an hour, yet the reasons for caution can remain intact for weeks. Overnight, the crypto market looks calmer, almost relieved. After a sharp sell-off, buyers return the way they often do when an asset becomes briefly oversold. The screen changes color, and the mind is tempted to believe the danger has passed. But markets do not heal because the chart looks better. They heal when the marginal seller is exhausted and when uncertainty stops multiplying in the background. Bitcoin has climbed back towards $65,000 after flirting with $60,000. You can read that move as a simple rebound, but we should ask what kind of selling preceded it. When flows around large exchange-traded funds suggest long-term holders finally dumping at a loss, that is not just movement, it is confession. It can be the bear market's final gasp. Yes, but it is also evidence that pain has reached people who thought they could wait forever. And the strength is not isolated. XRP, Solana, Ethereum, and other tokens have regained some poise, and a broad index of major coins has risen by roughly 9% since midnight coordinated universal time. This is the market reminding you that even after a fall, coordination resumes quickly when enough people judge the new price to be a bargain. Action returns the moment subjective valuations shift. Now, let us place a quiet question in the middle of this relief. If confidence has returned, why does protection still sell so well? Put options on Bitcoin remain in demand. That matters because options are not commentary, they are costly commitments. When people pay for downside insurance even while price rises, they reveal a split mind. Hope in the short run, fear in the structure of the situation. The bid for protection is the market's way of saying, we are not finished discovering what this shock will force people to do. One source of that fear is not inside crypto at all. Macro risks have eased, but they have not disappeared. A funding bill may have ended one shutdown drama. Yet another deadline approaches as certain agencies face cash constraints in about 8 days, reopening the possibility of another public spectacle by February 14th. You do not need to predict the outcome to see the mechanism. Recurring uncertainty raises the value of liquidity. And when people value liquidity more, they sell what is easiest to sell. Here is a midstream hook worth holding on to. The market does not fear bad news as much as it fears unreadable rules. At the same time, energy prices remain buoyant on both sides of the Atlantic, with traders watching geopolitical tensions that could escalate. If oil spikes, inflation expectations can revive. And when inflation anxiety rises, portfolios often rotate toward perceived safety. In that rotation, risk assets are treated as optional, not essential. Crypto, still largely held as a speculative store of future purchasing power, can be sold not because its story changed, but because the owner's time horizon suddenly shortened. But the most immediate pressure is simpler and more human. The recent crash pushed many holders underwater. Digital asset treasuries, funds, and individuals now sit on losses that alter their next decision. When you are down, you become more sensitive to further downside, more eager to get back to even, and more willing to sell into strength just to stop the bleeding. That is how yesterday's buyers become tomorrow's marginal sellers, and that is how rallies can be capped even in a rebound. Notice the contradiction. The rebound itself can create the supply that kills the rebound. This is why snapback recoveries so often crawl. After a crash, confidence does not return at the speed of price. It returns at the speed of lived experience. People need time to believe that selling pressure is truly spent, that leverage has been flushed, that the next headline will not force another wave of liquidations. Until then, every rise is also a test, and every test invites cautious selling. Even the dramatic details fit this logic. Bitcoin's bounce followed its worst one-day drop since November of 2022, with roughly $700 million in leveraged positions liquidated in a few hours. Liquidations are not merely losses, they are forced actions. Forced actions distort prices. And distorted prices take time to recoordinate, because participants must relearn what the undisturbed price would have been. Zoom out once more and you see the broader environment echoing the same theme. Equities have been rattled by fears around artificial intelligence and by volatility spilling across asset classes. Some major firms report weaker earnings or mixed results, while large technology companies project enormous spending on the artificial intelligence race, raising questions about energy supplies, costs, and whether today's numbers are quietly being pulled by one extraordinary investment cycle. When that kind of uncertainty spreads, it does not stay in one corner. It becomes a general preference for caution. So when you ask whether the market is out of the woods, we should answer in the only honest way. The woods are not a place on the chart. They are the set of constraints acting on human choices. Right now, those constraints still include macro deadlines, energy price risk, and a population of holders whose next action may be to sell simply because they can finally breathe again. Let us pause here together. The green candles may be real, but the recovery is not a color, it is a process of exhausted fear, restored calculation, and time. If you find yourself weighing optimism against unease, hold on to what you just saw. Markets move first, and understanding often arrives second. When you notice that gap in yourself, it is worth keeping close, because it is where the next decision will be made. When prices fall, why does one seller become another buyer? We are going to watch a single choice unfold inside a broader route, and you will see something quiet but decisive. When the market punishes an entire category, the real action is not panic. It is reallocation under uncertainty. You might think a falling market makes everyone do the same thing. Yet the truth is the opposite. The same price drop can compel one person to exit and another to enter, because each acts from a different plan and a different sense of time. On a Thursday shaped by a broad decline in crypto-related equities, ARK Invest reduced its position in Coinbase and increased its position in bullish, shifting capital, while the crowd was still reacting to the fall. ARK Invest sold roughly $17.4 million worth of Coinbase shares and bought a similar amount of bullish shares, right as the market was routing crypto equities and compressing valuations across the board. Let us start from the only solid ground. You act to replace a less preferred state with a more preferred one. When prices fall, nothing mystical happens. What changes is the menu of trade-offs, and every portfolio becomes a fresh set of decisions about what to hold and what to release. ARK Invest sold 119,236 shares of Coinbase, valued around $17.4 million at the close. Coinbase fell about 30% on the day, closing near $146.12, while the broader crypto market continued sliding. Now notice the deeper signal the price system is sending you. The fall is not merely a number on a screen. It is a public message that many plans at once are being revised. Some are forced to liquidate. Some are choosing to wait. Some are searching for a better fit between today's prices and tomorrow's expectations. In the same breath, ARK bought 716,030 shares of bullish, disclosed by email, valued around $17.8 million, based on a closing price near $24.90. Bullish itself fell about 8.5% on the day. Here is the paradox that wakes you up. In a downturn, the headlines make it sound as if risk is being rejected. But in reality, risk is being repriced. And repricing is exactly what invites entrepreneurial judgment back into the room. It is common to see ARK make sizable purchases of crypto-adjacent companies when prices slide with the broader market. If you manage a portfolio with a particular thesis, a downturn is not only pain, it is also information and an opportunity to rebalance toward what you now judge to be undervalued relative to alternatives. But we should not glide past the unusual part. It is rarer to see this window used to offload shares in a major crypto holding such as Coinbase while simultaneously adding exposure elsewhere in the same ecosystem. So ask yourself what this implies. It does not imply certainty. It implies preference. It implies that at these new prices, ARK judged bullish to offer a better alignment with its plan than an additional unit of Coinbase did, even though both were being dragged down by the same wave of selling. Midway through this reasoning, pause with us and look again at what you just witnessed. A crypto rout is not one event. It is millions of separate actions, each person trying to restore coherence between their expectations and their holdings, with prices acting as the shared language that makes coordination possible. And this is why the market looks chaotic from afar, but becomes intelligible up close. When you see selling and buying in the same storm, you are seeing the real function of prices. They do not soothe you. They inform you. We can end on a quiet recognition. The story is not that one firm sold and another asset was bought. The story is that falling prices did what they always do in a free process. They forced choices to become explicit. If you have ever rethought a purchase after the price changed, you already understand the whole mechanism. If you want, leave the single detail that most changed your view, and we will trace its logic together. If you believe in what we're doing and want to support BlockSonic's growth, just scan the QR code on the screen or copy the link in the description. Every contribution makes a difference and helps us keep delivering quality, independent, and up-to-date content for you. When leverage breaks, markets suddenly look clearer after Bitcoin hits its lowest since October 2024. You just watched a violent unwinding race. $2.6 billion in leveraged wagers push Bitcoin down to $60,000 and leave the entire market stretched into extreme oversold territory. Now, the question is not whether pain occurred, but what that pain reveals about how fragile coordination becomes when many people borrow the same conviction. You felt it, didn't you? The strange contrast between certainty and fragility. Because in speculative markets, confidence often rises at the exact moment resilience quietly disappears. On Thursday, the sell-off arrived with the cold efficiency of forced liquidation. More than $2.6 billion was wiped out as leveraged positions were closed, not by choice, but by necessity. And Bitcoin fell to $60,000, its lowest point since October 2024. Now we pause and ask you to notice what liquidation really is. It is not merely a price moving down. It is a chain of human plans, snapping under the same constraint, borrowed time. When many actors build their positions on leverage, they are not just buying an asset, they are renting patience. And when price moves against them, that rental agreement expires all at once. Here is the paradox that confuses most observers. The same decline that looks like pure chaos can also be the market restoring clarity. When forced sellers are removed, the price becomes less a stage for fragile promises and more a reflection of those who can actually hold. By one common measure of momentum, the drawdown pushed Bitcoin into one of the most oversold conditions in its recorded history. In plain terms, the selling became so intense that it historically tends to exhaust itself. And when selling exhausts itself, you often see a bounce not because the world changed, but because the marginal seller disappeared. Midway through this, let us ask a sharper question. If oversold conditions can precede a rebound, what exactly rebounds? Not an asset's essence. What rebounds is the balance between urgent sellers and patient holders. Price is not a prophecy. It is a temporary truce between competing time preferences. As Asia woke up, the tone improved. Bitcoin rose from $60,000 to above $65,000. Ethereum lifted from a low near $1,750 and traded again around $1,920. The light returned, not as certainty, but as evidence that the most desperate selling had passed. But we should not let a bounce lull you into forgetting the larger structure. A broader bear market is not defined by a single bad day or a single relief rally. It is a longer period in which many participants discover they overestimated demand, underestimated risk, or mistook easy financing for genuine strength. Look across the wider field and you see that discovery continuing. Zcash has lost 34% of its value over the past week. Optimism, Solana, and Ethereum have each been dealing with losses around 30%. These are not merely numbers. They are revisions of plans. They are entrepreneurs, traders, and savers, updating their beliefs about what others will pay and when. Another quiet hook for your mind. Why does stress appear to spread beyond one market? Because human action is connected by shared balance sheets and shared fear. When losses appear in one arena, people sell what they can, not only what they want. Correlations rise not because assets became identical, but because constraints became common. Even traditional markets have struggled in recent days. The Nasdaq 100 index dropped 6% since January 28th. Gold and silver fell by 12% and 38%, respectively, over the same period. Different instruments, different stories, yet the same underlying theme. When confidence tightens, liquidity becomes precious, and many people rush toward the same exits. So what do we take from this, you and I, if we refuse both panic and triumph? We take the simple lesson that markets are not machines that malfunction. They are processes where human plans meet scarcity, uncertainty, and time. Leverage accelerates both ascent and collapse because it compresses time preference into a contract. When that contract breaks, prices move fast, and the illusion of stability is revealed as borrowed. And now we end in a quieter place. If you felt the market brighten after the sell-off, it may be because the forced trades ended and voluntary exchange resumed its work of discovery. The order was always there, waiting beneath the noise, and perhaps you can see it more clearly now. If you have your own way of describing that moment when fear turns into clarity, hold it for a second and let us compare notes in the open. Weak earnings weigh on Iron and Amazon, as Bitcoin-linked shares find their footing. You are watching two worlds move at once, the world of disappointed forecasts and the world of revived monetary confidence. We will trace how earnings misses can chill artificial intelligence enthusiasm, while a rebound in Bitcoin can lift an entire cluster of businesses tied to it. You may think an earnings report is just a scorecard, but it is really a moment of economic calculation made public. When Iron reports results below what observers expected, you are seeing a gap between plans and reality, between entrepreneurial promises and the discipline of profit and loss. Iron's latest earnings reveal that gap clearly. The company missed what the market anticipated on both revenue and earnings per share, even as it accelerates its transition away from Bitcoin mining and toward artificial intelligence cloud services. Here is the paradox you should notice. The more a firm declares a new future, the more the present must still pay for it. Follow the numbers and the logic becomes unavoidable. Second quarter revenue declined to $184.7 million, below expectations and down from $240.3 million in the first quarter. At the same time, the company reported a net loss of $155.4 million, also below what the market had hoped to see. In plain terms, the costs of repositioning are arriving faster than the new revenues meant to justify them. Now we ask the next question a rational observer must ask. How does such a transition get financed when current performance disappoints? Iron secured $3.6 billion of graphics processing unit financing for its Microsoft contract. And together with a $1.9 billion customer prepayment, this is expected to cover around 95% of graphics processing unit related capital expenditure. You can hear the underlying structure. Future-oriented projects demand present resources, and those resources must be drawn from someone's savings, someone's willingness to bear uncertainty. Hold that thought because you will see the same tension in another corner of the market. Amazon also missed expectations on earnings per share while beating on revenue. The surface looks mixed, but the market's attention turns quickly to what truly governs long-run outcomes, the plan for capital expenditure. Here the focal point becomes Amazon's intention to spend around $200 billion on capital expenditure in 2026, primarily tied to artificial intelligence. This is not just a corporate headline. It is a declaration about time preference and about the belief that present sacrifice will yield future coordination and profit. Yet even the most ambitious plan must still pass through the narrow gate of scarce resources, which is why Amazon shares are down 10%. Now let us shift to the other world moving beside it, because markets rarely speak with only one voice at a time. Bitcoin rebounded from around $60,000 to $66,000, and you can watch sentiment change almost immediately. Not because people became wiser overnight, but because a price is a condensed message, and when it changes, countless plans are revised. That revision showed up in a broad rally across equities exposed to crypto. Strategy, the largest publicly traded holder of Bitcoin, rose 7% in pre-market trading. Galaxy gained 7%, Mara Holdings rose as well, and Coinbase increased by 6%. You are seeing a simple pattern. When the monetary asset strengthens, businesses whose balance sheets and revenues are tied to it are repriced upward, as if the market is correcting its own earlier pessimism. So we end with a quiet clarity. Earnings disappointments remind you that real resources cannot be willed into existence by narrative, and price rebounds remind you that confidence is not a slogan, but a continuously updated judgment expressed in exchange. If you felt a contradiction at the start, it resolves into one thought. Different sectors are not moved by one mood, but by many separate chains of human action, each responding to incentives, scarcity, and time. If this helped you see the hidden logic connecting a disappointing quarter, a massive investment plan, and a sudden rally in Bitcoin-linked shares, you may want to hold on to that lens and tell us what part of the chain felt most revealing to you. And don't forget to subscribe to the channel, like, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. Strategies planned for Bitcoin security under the shadow of quantum uncertainty. We are watching a familiar human pattern. People fear a future machine they cannot yet touch, while forgetting the quiet strength of a network that adapts through voluntary coordination. In this reflection, we will walk through Strategy's latest remarks and deduce what they reveal about incentives, uncertainty, and the practical art of preparing without panicking. You and we both know that every tool begins as theory, then becomes a constraint, then becomes a choice. Quantum computing is now crossing that threshold from abstract possibility into long-term strategic consideration. And Strategy made it plain that it prefers to act before pressure forces action, as it spoke during its fourth quarter earnings call on Thursday. Notice the logic of their position. If you hold a large reserve of Bitcoin, you are not merely holding an asset. You are holding exposure to the integrity of a monetary network. And so Strategy, described as the largest corporate holder of Bitcoin, says it plans to initiate a Bitcoin security program meant to coordinate with the global cyber, crypto, and Bitcoin security community. Here we meet the first paradox that matters. Quantum risk is discussed as if it were a sudden cliff, yet engineering reality tends to move by gradients. Strategy addressed the growing conversation and reaffirmed commitment to Bitcoin security, framing quantum not as an immediate threat, but as a future engineering challenge the network can prepare for. Now let us not look away from the conflict that markets always surface. Strategy reported a net loss of $12.4 billion for the quarter. Shares fell 17% on the day, trading as low as $104. And yet attention quickly migrated toward what Michael Saylor chose to emphasize. Ask yourself why. Losses and price declines are visible, but the deeper question is always about coordination under uncertainty. Saylor revisited a long list of historical Bitcoin fear, uncertainty, and doubt, reminding you that the network has already absorbed many alleged fatal blows. And he placed quantum concerns into that same category of claims that deserve analysis rather than reflex. But we should be precise here because reason does not dismiss risk by calling it fear. Saylor also acknowledged that quantum deserves serious long-term planning. That single phrase is the hinge. Not denial, not panic, but preparation grounded in time horizons. Strategy then outlined key points on quantum computing, predicting that quantum technology is likely more than a decade away, and pointing out that the Bitcoin community is already researching quantum-resistant cryptography. Do you see what this implies? When knowledge is dispersed, security is not a decree. It is an ongoing process of discovery, testing, and adoption, driven by those who bear the consequences. And here is a quieter mid-course question we should hold up to the light. If the threat is not immediate, why speak of it now? Because prudent actors do not wait for certainty to begin planning. They wait only long enough to avoid wasting scarce effort on fantasies, and then they invest in options that keep the future open. By the end of the sequence, the market itself offered a small epilogue. Shares were up 6% in pre-market trading as Bitcoin rebounded to $65,000. Price movements, as always, are not verdicts on truth. They are snapshots of shifting expectations. Let us pause together on what was actually revealed. Quantum uncertainty is real in the way all future uncertainty is real. It is not a prophecy. It is a constraint that may arrive. The deeper lesson is that resilient systems do not survive by pretending the world stands still. And they do not survive by surrendering to every imagined catastrophe. They survive by letting many minds prepare, coordinate, and revise. If you find yourself thinking through how a monetary network earns trust across decades, hold on to that question and carry it into your next conversation. It tends to reveal more than you expect when you let it sit quietly. When Job losses surge, why Bitcoin bulls start listening? You and we both know the paradox. Bad news in the world of work can become good news in the world of money. Here, we trace how quiet cracks in employment can shift expectations about easier credit, and why that change often lifts assets such as Bitcoin. You can feel the tension immediately. A cooling jobs market hurts real people, yet markets often treat it as a signal that easier borrowing may return. We begin with human action. Employers do not announce layoffs for sport. They do it when their subjective valuation of the future turns darker than their valuation of keeping payroll intact. When many firms make that same choice at once, we are not watching a statistic move. We are watching plans change. In the United States, planned layoffs surged to 108,435 in January, according to data tracked by Challenger, Gray, and Christmas. The jump was 205%. That is the highest January reading since January of 2009, the period when the collapse of Lehman Brothers was still fresh and the recession was still unfolding through everyday decisions. Now notice what makes planned layoffs so revealing. They are not yet the executed cut. They are the intention. They are the moment a company says to itself and to you, we no longer trust the near future enough to carry this cost. Year over year, announced cuts rose 118%. And the pattern is not abstract. The technology industry announced 22,291 reductions. Amazon accounted for most of that. United Parcel Service announced 31,143 planned cuts. Different lines of business, same direction of caution. A workplace expert at Challenger, Gray and Christmas, called it a high figure for January, even allowing for the fact that January is often seasonally weak for hiring. And this is where we pause, because the calendar excuse is an easy refuge. Here is the mid-content question you should sit with. If this is merely seasonal, why does the scale feel so unseasonal? The explanation offered is simple and therefore powerful. Many of these plans were set at the end of 2025, signaling employers are less than optimistic about the outlook for 2026. In other words, the announcements are the visible edge of decisions already made in boardrooms and budgeting meetings, where people act under uncertainty and choose restraint. Yet you will see a contradiction. Official payroll reports from the Bureau of Labor Statistics still paint a resilient picture. So which is real? We do not need to accuse anyone of error to understand the gap. Different measures see different slices of time. Official reports often arrive after the fact, once choices have already propagated. Private indicators sometimes catch intention earlier because they live closer to the moment plans are revised. And once you accept that, another clue fits into place. A blockchain-based measure called Truflation recently showed a sharp drop in real-time inflation to under 1%, even while the official consumer price index remains well above the target of 2%. Again, you are watching two clocks. One ticks faster, one ticks slower. Now we arrive at the market consequence, and it is not mystical. When enough observers believe the economy is weakening, they begin to believe borrowing costs will be pushed lower to provide support. Those beliefs alter portfolios before any meeting happens, because markets are made of anticipations, not of press releases. So the unofficial indicators together suggest that policy may soon relax through lower borrowing costs. And if easier credit is expected, assets that tend to benefit from rising liquidity often catch a bid. Bitcoin sits in that category for many traders, especially after it has fallen nearly 50% from its record high of over $126,000. But we should not skip the mechanism. Lower rates do not create prosperity by decree. They change the price of time. They reward present spending relative to future saving. They can lift asset prices even while the underlying real economy struggles to recoordinate. This month, the benchmark borrowing rate was left unchanged in the range of 3.5% to 3.75%, alongside renewed concern about inflation, and you can see the uncertainty in forecasts. One major bank expects rates to remain unchanged through this year and then rise sometime in 2027. Others expect at least 2 cuts of 25 basis points this year. Here is another mid-content hook worth your attention. When expert projections scatter, it is often because the underlying reality is in motion faster than the models can hold. One economist, known for correctly predicting Japan's fiscal issues, expects the incoming nominee for central bank chair, Kevin Warsh, to cut rates by 100 basis points before the midterm elections in November. Whether that specific path occurs is less important than what the prediction reveals. Many participants are already positioning for easier money. So what should you take from this quietly and without drama? When job loss intentions spike, they are telling you that entrepreneurs and managers are revising their plans. When inflation measures diverge, they are telling you that the information system is noisy and delayed. And when markets start talking about rate cuts, they are telling you that the price of time may soon be pushed downward, with consequences that ripple first through assets and only later through daily life. We can pause here together. The pattern is not new. It is simply easy to miss until you see how each actor, trying to protect their own future, unintentionally writes a message into prices. If you have ever felt that markets respond to suffering with indifference, hold that discomfort and examine the mechanism with us. In that examination, you may find the clarity that was always there, waiting to be named. And don't forget to subscribe to the channel, like, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. Bitcoins fall towards $60,000, and the sudden search for the seller no one can see. You can watch a price fall and still not know what happened because the market is not a storyteller. So when Bitcoin drops towards $60,000, you are not just seeing loss, you are seeing a vacuum where an explanation should be, and every mind rushes to fill it. You and I both know the paradox. Prices are supposed to clarify reality, yet a violent move can make reality feel less clear. When Bitcoin slid towards $60,000 on Thursday, the decline was not merely large. It felt discontinuous, as if the usual buyers stepped back at the same moment the sellers stopped caring about the price they received. And when that happens, you do not get a tidy narrative. You get a scramble for causes. So we observe the first human constant. When outcomes are painful, people search for intention. A mere shift in subjective valuations is never satisfying. It feels too impersonal. The mind wants an actor, a lever, a hidden hand that can be named. On X, traders began proposing that the sell-off was not simply broad fear or macro pressure, but something more specific and more forceful. They compared it to the most severe single day since the FTX collapse in 2022, not because the chart rhymed, but because the emotion did, the sense that selling was not chosen calmly, but compelled. Here is the first clue you can hold on to. When selling looks forced and indiscriminate, it often means someone is not optimizing for profit. They are optimizing for survival. They are meeting a margin call, a redemption, a collateral demand, a deadline that does not negotiate. A trader known as Flood described it as the most vicious selling he had seen in years, and he used a word that matters: Forced. Then he floated possibilities that all share the same structure. A large holder dumping billions. An exchange balance sheet rupture. Different stories, same underlying logic. An actor facing constraints tighter than their desire to wait. Now we can deepen the deduction. If a large seller is present, why would the market not identify them quickly? In liquid markets, repeated flows usually leave fingerprints. Yet, sometimes the fingerprints blur, not because the market is blind, but because the seller is isolated from the usual web of counterparties. Franklin Nispantara Capital offered a more detailed version of that thought. He suggested the seller could be a large Asia-based player with limited crypto-native counterparties, meaning the usual network of informed participants would not sniff them out quickly. And notice what that implies. Not all knowledge is shared evenly, and not all participants are embedded in the same information channels. Then comes the chain reaction that markets teach again and again. Leverage is quiet when prices rise and loud when prices fall. His view was that leverage on Binance may have been the first domino. Then the situation worsened as carry trades unwound and liquidity thinned. When liquidity evaporates, even small sales can create large moves, and large sales can create air pockets that feel like gravity suddenly increase. He added a further twist, an attempt to recover losses in gold and silver that failed, accelerating the unwind this week. You can see the human action beneath it. The trader who loses seeks a compensating gain. The compensating gain fails. The constraint tightens. The next action is not strategic. It is mechanical. But then the narrative takes an unusual turn. And this is where your curiosity should sharpen. Some traders did not focus on leverage at all. They focused on security. Charles Edwards of Capriole argued that falling prices may finally force serious attention on Bitcoin's quantum security risks. At first, that sounds disconnected from a Thursday sell-off. Yet the logic is not about physics. It is about incentives. If a network upgrade is costly and the risk feels distant, action is delayed. People postpone what does not yet hurt. But when prices fall, budgets tighten, confidence shakes, and the community becomes more willing to confront uncomfortable trade-offs. Edwards even said he was serious when he warned last year that Bitcoin might need to go lower to incentivize meaningful action, calling recent developments the first promising progress he had seen so far. So we arrive at a second paradox. A price decline can be both a symptom and a signal. It can reflect fear and also create the conditions for adaptation. Pain in markets often becomes information. Now let us introduce another competing explanation, because markets rarely grant us a single clean cause. Parker White, the Chief Operating Officer and Chief Investment Officer at DeFi Development Corporation, pointed to unusual activity in BlackRock's spot Bitcoin exchange traded fund, IBIT. He noted that IBIT posted its biggest ever volume day at $10.7 billion, alongside a record $900 million in options premium. And he argued that the pattern fit a large options-driven liquidation rather than the familiar crypto-native leverage unwind. You can feel the structure of that claim. Options can create nonlinear urgency. They can turn a gradual move into a sudden scramble, because hedges must be adjusted as thresholds are crossed. The selling, in that case, is not a view. It is a requirement. White admitted the epistemic boundary we all face in real time. He said he had no hard evidence, only hunches and breadcrumbs, but that it seemed plausible, and that humility is not weakness. It is realism. In markets, you often deduce from effects because direct knowledge is dispersed and delayed. Step back with me and notice what the price action itself has been saying. The drop over the past week has not looked like a slow grind. It has looked like sudden air pockets, sharp intraday swings replacing the orderly dip buying seen earlier in the year. That pattern is consistent with thin liquidity meeting urgent flows, not with a calm collective revaluation. The move dragged Bitcoin back toward levels last traded in late 2024. Liquidity looked thin across major venues. Alternative coins came under heavier pressure. Sentiment fell toward post-FTX style reading. And so traders began treating each rebound as suspect until flows and positioning visibly reset. Here is the quiet conclusion we can hold without pretending to omniscience. When narratives multiply, it is often because the market is telling you one simple thing in a complicated way. Someone needed to sell more than others were willing to buy. And the price had to fall far enough to find the buyer who would not flinch. And if you sit with that, you will see why the search for a hidden blow-up is so persistent. People want a named cause because it feels controllable. But the deeper truth is usually structural. Leverage, liquidity, and incentives interacting through dispersed knowledge until a single day reveals what had been building silently. If you find yourself forming your own theory, hold it gently and ask what constraint could make a rational person act irrationally fast. That question tends to age better than any headline. When record volume meets falling price, the moment capitulation becomes visible. You are watching a strange pairing unfold. A flood of trading at the very moment confidence seems to drain away. We will trace what this combination usually means in human action. Record volume, steady redemptions, and a sudden preference for protection can quietly reveal the psychology of peak selling. You and we both know trading can look like energy. But reason asks a sharper question. Is this energy the pursuit of gain or the escape from pain? On Thursday, BlackRock's spot Bitcoin exchange traded fund known by the ticker IBI printed a record that feels almost unreal. More than 284 million shares changed hands, according to Nasdaq data. In notional terms, that is over $10 billion of value being passed from one set of hands to another. Now pause with us and notice what a record truly is. It is not merely a statistic. It is a moment when many individuals, each with their own plans and fears, converge on the same action at once. To see the scale, compare it to the prior high of 169.21 million shares on November 21st. The jump was about 169%. When activity expands that quickly, it rarely does so for calm reasons. Here's attention. The volume surged while the price fell. IBI dropped about 13% to under $35, the lowest since October 11th, 2024. The year-to-date decline extended to about 27%, and the earlier peak, around $71.82 in early October, now reads less like a milestone and more like a memory people are trying to emotionally price against. This is where human action becomes legible. When prices rise, many trade to participate. When prices fall sharply, many trade to stop the bleeding. The same act, buying or selling, can be driven by opposite purposes. The fund also processed redemptions totaling about $175.33 million on Thursday. That was roughly 40% of the cumulative net outflow of about $434.11 million across 11 funds, according to Value. Redemption is not just movement on a screen. It is the choice to exit, to convert an uncertain holding into something felt as safer, clearer, more controllable. And remember what this vehicle is. IBI is the largest publicly listed Bitcoin fund of its kind. It holds the underlying coins and is designed to mirror the spot price of Bitcoin itself. It has served as a preferred route for institutions that want exposure through regulated products. In other words, it is a bridge for cautious capital to approach a volatile asset without stepping directly onto the open terrain. So when that bridge sees record traffic during a drop, reason asks you to consider what kind of traveler dominates the crowd. Are they arriving with patience or leaving with urgency? Bitcoin itself fell sharply as well, sliding to nearly $60,000 on Thursday. When the underlying asset breaks downward and the most widely used institutional wrapper sees both heavy turnover and redemptions, the pattern often aligns with what traders call capitulation. We can translate that into plain human terms. Long-term holders deciding that enduring further uncertainty costs more than realizing a loss today. Here's the paradox that confuses many observers. The most intense activity often appears near the end of a selling wave, not because certainty returns, but because exhaustion finally overpowers hope. People do not merely respond to prices. They respond to the emotional weight of time spent being wrong. This is why record volume paired with a price crash can mark what some call peak selling. Not a guaranteed bottom, but the phase where the marginal seller becomes less a speculator and more someone surrendering a position they once justified with conviction. Midway through this, another signal spoke in the language of hedging. Options trading in IBI showed a pronounced tilt toward longer duration, put options, contracts used to protect against further declines. Those puts reached a record premium, more than 25 volatility points above call options, according to Market Chameleon. In calm times, protection is cheap because few feel they need it. In fearful times, protection becomes expensive because many suddenly agree they cannot endure another surprise. Notice what that implies. The crowd is not merely selling. The crowd is paying up to insure itself against more pain. That is not optimism searching for opportunity. That is uncertainty being priced urgently. But we must keep our minds disciplined. None of this guarantees an immediate reversal. Bear markets can persist longer than even confident dip buyers can remain solvent. Time, not opinion, is the ultimate constraint. A person can be right about value and still be forced out by liquidity. So let us end where reason prefers to end, with what we can truly know from the pattern of action. Record volume, meaningful redemptions, and expensive downside protection often reveal a market wrestling with capitulation. It is the moment when many participants stop asking, "How high can it go?" and start asking, "How much more can I endure?" If you have ever felt that shift in yourself in any decision, not only in markets, you already understand the structure beneath the data. And if you want, leave your own reading of this moment in a sentence or two, so we can compare how different minds interpret the same visible acts. And don't forget to subscribe to the channel, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. Why a miner moves Bitcoin when prices shake. Reading Mara's $87 million trail. You and we both know a transfer is never just a transfer. It is an action, chosen under uncertainty, and the market treats it as a clue. Here we follow Mara moving 1318 Bitcoin across trading desks and custody venues, and we ask what the timing reveals about pressure calculation, and the thin line between routine management and forced selling. You might think the market moves on price alone. Yet watch what happens when coins move instead of candles. In anxious conditions, the same on-chain motion can be read as either calm treasury housekeeping or the first crack in a balance sheet. Over the past 10 hours, Bitcoin miner Mara shifted 1318 Bitcoin, valued around $86.89 million, to a mix of counterparties and custody destinations. As tracked by on-chain data observed by Arkham, we begin with the simple fact: coins left one set of hands and entered another set of addresses. But the meaning lies in what? The largest portion traveled to 2 Prime, a credit and trading firm. One transfer sent 653. Free Bitcoin, roughly $42.01 million, to an address tagged to 2 prime. And then, minutes later, a smaller addition followed. 8.999 Bitcoin, about $578,000. You can feel the market's mind here, because it immediately asks whether this is preparation to sell, or preparation to borrow, or preparation to reposition. Other outflows went elsewhere. 2 separate transactions sent 200 Bitcoin and 99.99 Bitcoin to an address tagged to BitGo, together worth about $20.4 million at the time. Another 305 Bitcoin moved to a fresh address, valued around $20.72 million. On the surface, this looks like dispersion. Under the surface, it is a portfolio being arranged for optionality. Now we reach the real reason anyone cares. Timing. Crypto markets have been swinging sharply since a liquidation-driven sell-off earlier the 10th for any hint that miners are becoming forced sellers. When fear is high, observers stop asking, what is typical, and start asking, what is necessary. Large miner-related transfers can be ordinary treasury management, custody reshuffling, collateral movements, or preparation for an over-the-counter sale. Yet in a thin market, they are often interpreted as a supply signal. This is the paradox you must hold. The same action can be prudent internal accounting and still alter expectations externally, because expectations themselves are a traded asset. Notice why the 2 prime portion draws the brightest spotlight. A credit and trading counterparty suggests strategies beyond simple storage. If the Bitcoin is being posted as collateral or rotated into a structured approach, it does not automatically imply spot selling. But you can see why the market watches it anyway. Credit links the coin to leverage, and leverage links the coin to forced decisions when prices fall. All of this arrives during a difficult stretch for miners. Bitcoin is down nearly 50% from peak prices above $126,000 last year. When revenue falls, but fixed obligations remain, the miners' freedom narrows, and the market becomes obsessed with whether they will liquidate inventory to survive. We can sharpen the pressure further. Bitcoin is now about 20% below its estimated average production cost, as reported on Thursday by CoinDesk, increasing financial strain across the Bitcoin mining sector. Here, the logic is simple and unforgiving. When the selling price sits below the cost of creation, the producer must either endure losses, find cheaper inputs, or reduce operations. Data from Check-on-Chain places the average cost to mine 1 Bitcoin around $87,000, while the spot price has fallen toward a weekly low near $60,000. Historically, trading below production cost has been a feature of bear market conditions. Not because it is normal, but because it is the market's way of forcing reallocation toward those who can best endure scarcity. So when you see Mara's coins move, do not ask only, will they sell? Ask the deeper question, what constraints are tightening and what options are being purchased with this movement? In a world of uncertainty, liquidity is not merely cash. Liquidity is the ability to choose. If you find yourself rereading these transfers with a calmer eye, that is the point. The chain shows motion, but reason reveals structure. And once you see the structure, you start noticing it everywhere. If you want, leave your own interpretation of what this pattern most likely signals, and we will test it against the logic of action. When fear becomes a price, Bitcoin volatility returns to the FTX peak as value falls near $60,000. You are watching something subtle but decisive. When the crowd cannot agree on tomorrow, the price of uncertainty itself gets bid up. We will trace how Bitcoin's fall towards $60,000 pulled its volatility gauge back to levels last seen during the FTX collapse, and why options markets often confess panic before spot markets find their footing. You might think the headline is about Bitcoin falling, but the more revealing event is that uncertainty became expensive again. When human beings cannot coordinate their expectations, they do not stop acting. They simply shift their action from owning the asset to buying protection around it. And that is why a volatility index can spike even while everyone is staring at the price chart. Here the signal is a particular gauge, Volmex Bitcoin Volatility Index, commonly shortened to the letters BVI. Its purpose is straightforward. It translates the options market's collective willingness to pay for insurance into an annualized expectation of turbulence over roughly 4 weeks. Now, notice the movement. The index rises from about 56 to nearly 100. You do not need poetry to interpret that. You need only the logic of bidding. When more people urgently want protection than are willing to sell it cheaply, the premium rises and implied volatility climbs with it. This is why such an index is often compared to the well-known volatility gauge tied to a broad basket of large equities. The analogy is not about technology. It is about human action under uncertainty. In both cases, panic expresses itself through options, because options let you define your loss while keeping open the possibility of gain. Pause with us here, because this is the first paradox. The very instrument designed to manage fear becomes the instrument that measures it. The more you demand protection, the more the market announces that protection is scarce. A founder at Volmex describes what you can already infer: a wave of panic, not isolated to one corner, but correlated with a broader move away from risk across many assets. In a matter of days, implied volatility leaps from the low range to the mid-90 range, echoing levels not seen since the infamous collapse of FTX near the end of 2022. The details matter less than the pattern. When coordination breaks, the price of coordination tools rises. To understand the mechanism, we must be clear about implied volatility. It is not a mystical forecast. It is a consequence of option prices, and option prices are consequences of competing plans. Some traders buy calls to profit from upside. Others buy puts to insure against downside. Both are expressions of subjective valuation, shaped by time preference and by the felt cost of being wrong. And when the market drops quickly, being wrong becomes intolerably expensive for many plans. So you see traders rushing toward puts listed under Ribbit, especially as Bitcoin falls from about $70,000 toward nearly $60,000. The most traded contracts cluster around strike prices that tell a story of fear, reaching far below the present price, even down toward $20,000. A low strike put is not a prophecy. It is a willingness to pay for survival in a scenario you cannot rule out. Here is the midpoint question you should hold. If so many are buying protection at once, who is on the other side? Calmly selling it. And at what price must they be tempted to do so? A liquidity provider explains the next layer. Short-dated volatility surges first, because near-term risk is what hurts portfolios immediately. Dealers adjust their exposure to small price moves, and the demand concentrates in the front end of the curve. Longer-dated volatility lags, not because the future is safe, but because the urgency is immediate. The curve inverts because fear is not evenly distributed through time. This brings us to the real conflict underneath the charts. Many treasuries and balance sheets acquired Bitcoin at higher levels. When price falls sharply, their plans collide with their constraints. If they must sell to meet obligations, they can turn a decline into a cascade. The market senses this possibility, and the options market prices it faster than narratives can. Uncertainty compounds uncertainty. People buy protection not only against price movement, but against the forced actions of other people. And yet, even in panic, the market continues its search for a clearing point. Bitcoin later rebounds to above $64,000, recovering more than 5% from the overnight lows. This does not refute the fear. It merely tells you that some participants judged the new price attractive enough to act, while others judged the insurance expensive enough to stop bidding. it higher. The same liquidity provider expects volatility to stabilize. That expectation rests on a simple conditional. If price action steadies near a perceived base around $60,000, then the implied volatility that was stretched by urgent hedging can retreat as urgency fades. We end where we began, but with clearer sight. The price of Bitcoin moved, yes, but the deeper motion was the market repricing uncertainty itself, in real time, through voluntary exchange. If you have ever wondered where fear becomes visible, it is here, not in words but in premiums. Sit with that for a moment, and you may notice a quiet shift in how you read markets. If this helped you see the logic beneath the panic, you might want to keep your own note of what you observed today and compare it to the next time uncertainty becomes costly again. And don't forget to subscribe to the channel, like, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. Why a resurfaced Iran warning can shake Bitcoin before any talks even begin. You are watching a familiar pattern return. Headlines about distant conflict do not need to be new to move prices, because what really moves is the market's fragile structure, and the traders need to act under uncertainty. You and we both know the strange paradox here. A warning can be old, the facts can be unchanged, and yet the price can still lurch as if reality itself just shifted. An advisory urging American citizens to leave Iran now has begun circulating again online, and you can feel what that does in a market already tense from sharp swings and forced liquidations. Now we slow down and ask what matters. Officials have clarified that the advisory is not new and that it first appeared in mid-January. Yet the market does not trade on freshness alone. It trades on attention, timing, and the expectation that other people will react. And the timing is doing the work. The advisory is resurfacing just as nuclear talks are expected to be held in Oman on Friday, with President Donald Trump issuing public warnings toward Iran's supreme leader, Ayatollah Ali Khamenei, and with Tehran signaling retaliation if attacked. Here is the first deduction we want you to hold. Traders are not being asked to price a single event, but to price uncertainty layered on uncertainty. When you cannot calculate outcomes cleanly, you fall back on what you can control, reducing exposure, cutting leverage, seeking liquidity. So the immediate takeaway is not whether the advisory is recent. The takeaway is what the market has become, a leveraged macro wager that can be pushed around by shifting narratives. In that posture, Bitcoin tends to move the way high beta technology shares move, not the way gold tends to move. And this is where the hidden mechanism reveals itself. Bitcoin has already been swinging widely after a week shaped by liquidation-driven selling. When many positions are built on borrowed footing, price declines are not merely declines, they become triggers. A small move forces selling. Forced selling creates a larger move, and the larger move forces more selling. Pause with us here, because this is the mid-story hook. Ambiguous news does not need to be meaningful to be powerful when liquidity is thin. In perpetual futures, where leverage is easy and exits can become crowded, even unclear signals can set off rapid deleveraging. You may have noticed the repeated pattern. When geopolitical drama rises into view, digital assets often sell off while people run toward what they perceive as safety, such as gold or bonds. We are not describing what is noble or foolish. We are describing preference under fear and action under scarcity of certainty. Now we return to the headline itself and strip it down. The Iran narrative may fade, especially if the Oman talks proceed smoothly. But a market that is still absorbing heavy losses is a market with brittle sentiment, and brittle sentiment turns each new headline into a test of resolve. So if you are looking for a clean directional signal, you will likely be disappointed. In this environment, geopolitical developments function less as a compass and more as an accelerant, increasing volatility regardless of where the long run settles. Let us end with the quiet point that makes everything else click. The headline is the spark, but leverage is the dry forest. If you want to understand the next sharp move, watch not only the news, but the structure of positions beneath it and the thinness of the exits. If you have seen this pattern before in your own decisions, you may want to hold that recognition close and compare notes with others who are also trying to see what is really moving. When Bitcoin leaps back above $65,000 after an Asia liquidation whipsaw, you are watching a market where conviction whispers and leverage shouts. We will trace how Bitcoin fell towards $60,000, how forced exits erased hundreds of millions in positions, and why the rebound above $65,000 may say less about belief and more about fragile structure. You feel the paradox immediately. The same crowd that sells in fear can buy in urgency, and both acts can be driven by the same mechanism. In Asia on Friday, Bitcoin rebounded sharply after a fresh wave of selling pushed it down towards $60,000, extending a drawdown that has carried the largest cryptocurrency to more than half below its October peak. Now observe the sequence, because sequences reveal causation. Bitcoin fell as much as 4.8% to around $60,033 during late United States hours, and then snapped back as high as $65,926. This followed Thursday's 13% slide, its steepest one-day drop since November of 2022 second, when the collapse of Sam Bankman-Fried's FTX wars. Here's our first mid-course question for you. When price moves this violently, are you seeing new knowledge enter the market, or old positions being mechanically unwound? The bounce arrived as liquidations surged again, sweeping away leveraged positions that had accumulated during the week's decline. In other words, many participants were not choosing freely in that moment. Their earlier choices had already written the script. The numbers tell a human story of commitment made under uncertainty, then revoked under constraint. Roughly $700 million in crypto bets were wiped out over the past 4 hours, according to CoinGlass. About $530 million came from long positions, and about $170 million from shorts, suggesting a familiar pattern. Traders were first crushed on the way down, then caught leaning the wrong way on the rebound. And yet you also notice something quieter beneath the machinery. The move appears to have drawn in spot buyers, with $60,000 acting as a psychological line watched for weeks. This is not mysticism. Round numbers become coordination points because human attention is scarce, and crowds economize on thinking by using simple focal anchors. Damien Lowe, Chief Investment Officer at Ericsson Capital, described the rebound as evidence of strong support around that level, while warning that sentiment remains fragile, given the broader market backdrop. We can translate this into plain logic. Even if buyers exist at $60,000, their willingness to persist depends on what they believe will happen next, and on whether they are funding those beliefs with real savings or borrowed time. Let us widen the lens, because the same structure repeats across related assets. Altcoins mirrored Bitcoin's whipsaw. Solana fell as much as 14% at one point, then erased those losses within hours. When liquidity thins, small imbalances become large moves, and forced selling can replace deliberate exchange with something closer to evacuation. Here is the second hook to hold on to. When many traders must act at once, price stops being a calm messenger and becomes a siren. The broader crypto market has been shaky since a series of liquidations in October rattled confidence, and the latest drawdown has been amplified by turbulence in global markets, where investors have been dumping speculative assets. In such moments, correlation rises not because the assets became identical, but because the same kind of holder is trying to exit the same kind of risk. Then the consequences spill outward, as they always do when balance sheets are tied to volatile valuations. Strategy, led by Michael Saylor, reported a $12.4 billion fourth quarter net loss on Thursday, driven by mark-to-market declines in its Bitcoin holdings. You see the chain. A price drop is not merely a chart event. It becomes a constraint on future action for firms whose plans were built on yesterday's valuations. So even with Friday's bounce, traders say the market still looks like one pushed around by leverage rather than conviction. We can state it more generally for you. When borrowing dominates, the marginal buyer is not the patient saver, but the fragile speculator, and the market's tone becomes jumpy because the weakest hands set the next transaction. Now we pause together, because the lesson is not about any single price level. It is about structure. A rebound can be real and still be mechanical, and a sell-off can be loud and still contain little new information. If you want to understand what you are seeing, ask a simple question each time the chart jolts. Who is choosing and who is being forced? If this way of tracing action through incentives clarifies what looked like chaos, hold on to it and tell us what part of the sequence you think mattered most. Bitcoin is not failing against gold. It is meeting a liquidity test gold rarely faces. You and we can debate prices all day, but price is only the surface where deeper forces leave their trace. What we are really watching is a difference in market depth and in how credit is handled when leverage breaks. Once you see that divide, Bitcoin and the rest of the digital asset world stop looking like one story. You might think the question is simple. Is Bitcoin losing to gold or not? But we should pause, because the mind often mistakes a visible number for the cause behind it. Price is an effect. Liquidity, credit, and the structure of the marketplace are closer to the cause. When those foundations shift, two assets can tell opposite stories in the short term while still serving similar long-horizon purposes. Here's the first deduction we make together. When you compare Bitcoin to gold, you are not comparing two objects of equal mass moving through the same medium. You are comparing two markets with radically different scale and plumbing. Gold is embedded in older institutions, deeper pools of buyers, and a larger base of habitual demand. Bitcoin is younger, more reflexive, and more sensitive to forced flows. So when gold appears to dominate, it can be less a verdict on meaning and more consequence of structure. A very large market can absorb shock without showing it as drama. A smaller market, even when it is healthy, can be pushed around by the unwinding of positions. What looks like weakness can be a simple arithmetic of depth. Now we reach the tension that matters. Gold can swing in daily value by an amount that rivals the entire valuation of Bitcoin. If you hold that image in your mind, you see why short-term divergence can become a physics problem rather than a narrative defeat. The stories may converge over years, while the tape diverges over days. And yet, the more revealing event was not gold's rise. It was the deleveraging episode on October 10th, the moment when leverage snapped and the market learned what it had been pretending not to know. Midway through this reasoning, ask yourself a sharper question. What happens to trust when a marketplace is stressed? In calmer times, many digital assets appear to move together as if they share one bloodstream. But when forced unwinds arrive, liquidity stops being a slogan and becomes a measurement. That day drew a clear line between Bitcoin and the broader field of altcoins, not because beliefs changed overnight, but because depth and credit mitigation were exposed under pressure. What remained after the forced unwinds was not merely lower prices, it was a thinner landscape, and in thin landscapes, price becomes jumpy in both directions. The same lack of depth that accelerates declines can also create violent rebounds. Volatility here is not a personality trait. It is a mechanical consequence of scarce liquidity. Now we come to the quiet contradiction at the heart of many trading venues. In more layered financial structures, there are buffers between a shock and the end user. Losses are processed through brokers, clearing mechanisms and rules that are designed to be predictable under stress. In many native crypto venues, the structure is simpler and therefore more fragile. The venue can become a single point where risk concentrates. When positions go bankrupt, the venue leans on equity, insurance funds, and in extreme cases, something that breaks the social contract of trading, socialized loss. We should define that plainly, because clarity is the beginning of trust. Socialized loss is when an exchange cannot cover bankrupt positions with its insurance fund, and so it closes or reduces profitable traders' positions to cover the shortfall. Winners are made to pay for others' losses. That is not merely a transfer. It is a revelation that the rules are not what you thought they were. And here the logic becomes inevitable. The moment a venue triggers socialized loss, the trader stops fearing volatility and starts fearing governance. Volatility is a known discomfort. Uncertain liquidation. Rules are a fundamental uncertainty. You can price the first. You cannot easily price the second. Worse still, people notice inconsistencies. Some products appear protected while others take the hit. Whether or not the perception is perfectly fair, the consequence is real. Trust decays more slowly than price. Leverage and volume can return quickly when memories fade. Confidence in liquidation governance returns on a longer clock. Though the landscape divides, Bitcoin retains relative credibility because it tends to have deeper liquidity and a clearer role as collateral. Much of the altcoin complex trades with a structural discount, not only because of macro conditions, but because traders must also price venue design and counterparty uncertainty. This is the second mid-content hook we should sit with. When an asset trades, is it trading on its thesis or on the reliability of the marketplace that carries it? From this angle, Bitcoin still behaves for many participants like a long horizon hedge against monetary dilution and a more legible form of collateral. Many altcoins behave more like a bet on market microstructure, order book depth, and the rules a venue will enforce when stress arrives. And the final deduction is almost too simple, which is why it is often missed. When something has poor liquidity, it can fall far. It can also rise far. The amplitude is not always a sign of destiny. It is often a thinness. If we briefly translate the recent tape into human language, you see the same mechanics. Bitcoin plunged under liquidation pressure toward roughly $60,000, then rebounded sharply, a move consistent with an oversold snapback when positioning is forced to unwind. Ether fell hard as well, then bounced as the same mechanical pressure released. Gold pulled back too, though its longer arc is still shaped by persistent large buyers and broad concerns about debt and currency confidence. Asian equities weakened as risk appetite cooled, carrying other volatile assets with them. But notice what ties this together. The story is not that one asset is virtuous and another is doomed. The story is that market structure determines how stress is distributed and therefore how trust is earned or lost. Let us end in a quieter place. If you came here asking whether Bitcoin is losing to gold, you may leave seeing a different question. Which market can process leverage, liquidations, and uncertainty without rewriting the rules mid-storm? Hold that question for a day, and you may notice it reshapes how you interpret every chart you see. If it does, you will know the insight was always there. You simply had not yet named it. And if you find yourself returning to this distinction later, it may be worth keeping close, the way one keeps a useful tool within reach. Bitcoin exchange-traded funds barely move as Bitcoin falls 40%. And we ask why. Bitcoin has fallen more than 40% from its October highs, yet the holders of spot Bitcoin exchange-traded funds have withdrawn only 6.6% of assets. We are going to sit with that tension and deduce what it reveals about who holds Bitcoin, how they experience risk, and why the wrapper you choose can quietly change your behavior. You might think a 40% fall would force panic into the open. Yet here we see something calmer. The price drops, but most exchange-traded fund holders do not run. So we begin where all clarity begins, with human action. When people do not sell, it is not because they feel nothing. It is because their plan, their constraints, and their interpretation of the same event differ. In the latest drawdown, exchange-traded fund investors are proving more resilient than many expected. In a conversation on a Markets Outlook program, Bloomberg Intelligence senior exchange-traded fund analyst Eric Balchunas points to data that matters precisely because it is mundane. Assets did not flee in proportion to fear. And whenever the crowd does not behave as the headline predicts, we should ask what structure is shaping their choices. Here is the first deduction. An exchange-traded fund holder is often not the same creature as a crypto-native trader. Not morally, not intellectually, but structurally. The fund sits inside familiar account rails. Familiar reporting, familiar routines. The act of selling is not a swipe born of adrenaline. It is a decision that competes with other decisions in a portfolio, under rules and habits that were built for patience. Now, notice the paradox. The same price drop can feel radically different depending on exposure. To a trader living inside perpetual screens, the fall is a constant sensory event. Every tick is a new invitation to act. To a fund holder, the fall may be a quarterly statement, a line item among many, an allocation whose purpose was never short-term victory, but long-term participation. The price is the same, but the experience of the price is not. Midway through this, we should pause and ask you a sharper question. When you say, people are panicking, do you mean the owners of the asset, or do you mean the most visible actors around the asset? Markets often look more emotional than they are, because the loudest actions belong to those with the shortest time horizons. Balchunas draws a comparison that helps us see the pattern. Gold exchange-traded funds. Once an asset becomes exchange-traded fund wrapped, it becomes legible to a different class of planner. It can be held by people who do not want to master every operational detail, yet still want exposure. That does not remove volatility, but it can change the composition of holders, and composition changes the rhythm of selling. This is not magic, and it is not a promise of stability. Volatility is likely to persist because Bitcoin still sits inside a world of shifting expectations and uncertain future use. But if exchange-traded funds continue to gather and retain capital, they may serve as an anchor in the sense that they normalize holding. Not by freezing price, but by widening the set of people whose default action is to wait. So what comes next is not a forecast, but a framework. If the exchange-traded fund channel keeps growing, Bitcoin's place in conventional portfolios becomes less of a daring bet and more of a calculated allocation. And when ownership shifts from the most reactive hands to more deliberate ones, drawdowns can look less like mass exits and more like a test of conviction. Let us end quietly with what this episode is really teaching. The market did not become calmer. The holders changed, and with them the meaning of the same price movement. If you have ever wondered why two people can watch the same chart and feel opposite impulses, keep this thought close and return to it when the next drop arrives. It may be useful to ask yourself which structure you are acting within, and what kind of person that structure is training you to become. When Bitcoin falls, strategy reveals the cost of holding through the storm. You and we both know a curious truth about voluntary choice. The same decision that feels visionary in rising times can look reckless when prices turn. Here, we watch strategy record a vast quarterly loss, not because its people stopped acting, but because the market changed its verdict on Bitcoin between early October and year-end. You and we begin with a simple tension. If a firm treats Bitcoin as a long-term anchor, why does a short-term price move suddenly dominate the story? We will trace that path from falling prices to accounting losses to the quieter question investors really want answered now. What does strategy do next when the market no longer flatters conviction? You can feel the paradox immediately. A company can hold the same asset in the same quantity with the same intention, and yet appear to become less successful overnight. We are watching strategy report a net loss of $12.4 billion in the fourth quarter of 2025, while Bitcoin fell from about $120,000 on October 1st to roughly $89,000 by the end of the year. Notice what is happening beneath the headline. The firm did not wake up one morning and decide to value its holdings less. The market did that through countless individual trades, each one an act of subjective valuation. Price is not a decoration on reality. Price is reality condensed. And you can see how quickly that verdict can intensify. After the period ended, Bitcoin sank further in recent weeks, then dropped sharply on Thursday to around $64,000, just ahead of strategy's results. Now, the conflict shifts from the asset to the bearer. Strategy's shares closed that session down 17%, one of their worst performances in years, before edging up modestly in after-hours trading. The crowd is not inconsistent here. It is simply updating its expectations about what the firm's future choices might look like under pressure. Here is a mid-course question worth holding. When you buy an asset whose price can swing this violently, are you investing in a thing? Or are you investing in your own ability to endure uncertainty? We are told the company is led by Executive Chairman Michael Saylor, and that it is the largest corporate owner of Bitcoin. It currently holds 713,502 Bitcoin, purchased at an average price of $76,052, a figure that includes several $1 billion of purchases made since the end of the fourth quarter. Pause with us and consider what that means in human terms. A buyer does not purchase Bitcoin in general. He purchases at a particular moment, at a particular price, believing that this use of scarce resources will serve his preferred future better than the alternative. The average cost is a historical footprint of many such moments. Then we come to liquidity, the quiet constraint that always reappears when prices fall. Strategy ended the year with $225 billion in cash, which it says would allow for 2.5 years of dividend coverage on its preferred stock, as well as interest on its debt. This is where the story becomes more than a chart. Falling prices do not merely change paper values. They change the range of feasible actions. Cash reserves, debt service, and dividend obligations are not theories. They are calendars of required payments, arriving whether sentiment is calm or afraid. So, the coming focus is predictable. With the fourth quarter results being little surprise, investors will look to the earnings call at 5 post-meridium Eastern Time for Saylor and his team's comments about their plans given the current state of the market. And here we arrive at the deeper truth you can carry beyond this one firm. Losses and gains are not just numbers. They are signals telling entrepreneurs and savers whether their past actions aligned with the most urgent wants of others as expressed through prices. We will end quietly, because the lesson does not need volume. When a price falls, it is not merely an asset that declines. A whole set of expectations is being revised in real time. If you have ever held conviction through a changing market, you already understand the question strategy must answer next, even before anyone speaks on the call. If you find yourself lingering on that question, stay with it and tell us what you think the market is really testing here: the asset, the balance sheet, or the human willingness to hold uncertainty without blinking. Thank you so much for following BlockSonic today. See you soon with more news, analysis, and market alerts. Keep an eye on Bitcoin and continue listening to the sound of the blockchain.